Robert Lichello's AIM, Automatic Investment Management. Strategy isn't one of those get-rich-quick schemes or trendy options trading courses flooding the internet. It's a simple, methodical way to invest that stands apart from the crowd. So why hasn't this strategy taken off and become the go-to for investors? Well, let's dive into the reasons behind AIM's enduring obscurity. Understanding why AIM remains relatively unknown can provide insight into how it works and why it might be worth considering. First up, let's talk about what AIM is all about. Automatic Investment Management, or AIM, is an investment strategy created by Robert Lichello, who introduced the strategy in his book How to Make $1 Million in the Stock Market Automatically. This approach emphasizes discipline over intuition, letting a pre-established set of rules guide your investment decisions rather than relying on gut feelings or market predictions. At its core, AIM is designed to take advantage of market volatility by automatically buying more when prices drop and selling when they climb. This systematic approach helps investors maintain a balanced portfolio and potentially boost long-term returns. However, in today's fast-paced investing environment, filled with get-rich-quick schemes and flashy trading strategies, AI's straightforward approach may seem less exciting. One of the primary reasons for AIM's lack of popularity is that it simply does not offer the allure of quick riches or the thrill of making hot stock picks. Instead, it's a slow-burning strategy that focuses on consistent, steady growth over time. This goes against the grain in a world where social media feeds are flooded with stories of individuals making massive profits in a short span of time. AIM doesn't align with the hype, which could be a significant barrier to attracting a large following. The strategy's reliance on volatility also makes it less appealing to a broader audience. Many investors seek investments that provide smooth, uninterrupted growth, but AIM's buy low, sell high approach can lead to temporary losses, which might scare off risk-averse investors or those without a long-term perspective. AIM's reputation as a complex strategy might also be keeping it out of the spotlight. While the strategy itself is relatively easy to understand, implementing it successfully requires dedication and attention. Unlike automated robo-advisors that handle everything for you, AIM involves manual tracking of your portfolio, calculation of cash reserves, and execution of trades according to predefined rules. This level of involvement can be daunting for investors seeking a more hands-off approach, especially in an era where technology has made investing more accessible and convenient than ever before. Another factor contributing to AIM's limited popularity is a lack of exposure and education. Unlike newer investment approaches, AIM was introduced in the 1970s and has not received the same level of attention or marketing in recent years. This lack of visibility means that many investors have never heard of the strategy, let alone considered adopting it. Educational institutions and financial advisors also play a role in shaping investors' knowledge and perceptions of different strategies. However, AIM is rarely taught in finance courses or promoted by major financial institutions, which further contributes to its obscurity. Additionally, AIM's performance compared to more aggressive investment strategies might be putting some people off. During strong bull markets, AIM's emphasis on cash reserves and balanced portfolio can result in lower returns compared to investors who heavily allocate their funds to stocks, especially to younger investors who have witnessed the impressive growth of the stock market in recent years. In summary, AIM's failure to gain widespread recognition is likely due to a combination of factors. Its focus on long-term growth rather than short-term gains, its requirement for manual oversight, its limited exposure and education, and occasional underperformance compared to aggressive investment strategies have all contributed to its obscure status. However, while AIM may not be the most popular strategy out there, it continues to have a dedicated following among investors who appreciate its simplicity, discipline, and potential for generating solid long-term returns. So now that we've discussed the reasons behind AIM's enduring obscurity, it's time to shift our focus to the advantages it offers. Despite not being a household name, AIM has several unique features that make it stand out as a viable investment strategy. One of the key strengths of AIM is its ability to help investors maintain a balanced portfolio. By regularly rebalancing your asset allocation back to your target percentages, AIM ensures that you don't become overly exposed to any single investment or sector. This is especially beneficial in times of market volatility. as it prevents you from making impulsive decisions driven by fear or greed. Additionally, AIM's built-in risk management is another major advantage. The strategy incorporates a significant amount of cash into your portfolio, typically between 20 and 30%, which serves as a buffer to absorb potential losses. This cash reserve not only provides peace of mind, but also allows you to take advantage of market downturns by purchasing additional assets at discounted prices. By including cash in your portfolio, you're essentially protecting yourself against unforeseen circumstances or sudden changes in your financial situation. Furthermore, AIM offers a clear set of rules that help investors stay disciplined and avoid emotional decision-making. Unlike discretionary investing, where choices are based on individual circumstances and intuition, AIM provides a structured approach that removes subjectivity. This is particularly helpful for beginners or novice investors who may not have the experience or confidence to navigate the market on their own. By following a pre-established set of rules, AIM ensures that your investment decisions are based on logic and data rather than emotions such as fear or greed. Now that we've covered some of AIM's key advantages, it's important to acknowledge that no investment strategy is without its drawbacks. AIM also has some limitations that potential investors should be aware of before diving in. One of the main challenges associated with AIM is its complexity. While the overall strategy is relatively simple, implementing it successfully requires attention to detail and consistency. Tracking your portfolio. Calculating cash reserves and executing trades according to predefined rules can be time-consuming. Additionally, AIM's performance compared to other investment strategies might be a concern for some investors, as mentioned earlier, during strong bull markets. AIM's balanced approach can result in lower returns compared to those who take on more risk. For instance, investors who allocate their funds to growth stocks or cryptocurrencies might see higher returns in the short term, even if those investments eventually decline. Lastly, AIM's suitability for different investor types is another consideration. The strategy's focus on long-term growth and volatility might not align with the goals or risk tolerance of all investors. For example, those nearing retirement and seeking a more conservative approach, or investors with a low tolerance for market fluctuations, might find AIM's balanced portfolio and cash reserves insufficiently cautious. It's crucial to assess your individual circumstances and investment objectives before deciding whether AIM aligns with your financial needs. In conclusion, while AIM offers several compelling advantages, including portfolio balance, built-in risk management, and a disciplined approach, it's essential to acknowledge its limitations. The strategy's complexity, performance during bull markets, and suitability for different investor types are all aspects that should be carefully considered before implementation. Ultimately, the decision of whether to pursue AIM or explore other investment strategies depends on your unique financial situation and goals. As we wrap up our discussion on AIM, it's important to note that, despite its complexities and limitations, the strategy continues to attract a loyal following. Investors who value emotional detachment from market swings, systematic rebalancing without forecasting, built-in risk management via cash reserves and simplicity. No need for technical analysis or macro predictions. Find solace in AIM's straightforward approach. It's a reliable companion on their journey towards long-term financial success. If you've stuck around until the end, you're probably curious about what's next. We'd love to hear your thoughts. You think AIM has a place in the modern investment landscape? What strategies do you use to stay financially on track? Drop a comment below and let's continue the conversation. And hey, if you found this video helpful, don't forget to hit the like button and subscribe for more insightful content. Thanks for watching.